Okay, so now we're going to talk about the investment demand curve. So we want to figure out what is the relationship between the interest rate and the demand for new investment. So if we reference our circular flow model, recall that we have the goods and services market. And what are we trying to do? We're trying to measure the amount of spending that occurs in this market. In the previous video, we looked at what drives consumption from the household sector, and now we're going to look at what drives investment from the business sector. And we want to know how much investment is occurring and how this occurs, what drives that investment. So now a lot of times the machinery and equipment that businesses need to buy is very expensive. So they may not have that money in their own reserves. So what they do then is they have to go to the financial market to borrow money. So the businesses will go to the financial market and they're going to borrow money, and then that money is going to be used to invest in the goods and services market. So what we need to look at then is, well, what is the relationship between the interest rate that they pay for the money and the expected rate of return that they anticipate they're going to get from the equipment that they are purchasing? So why do businesses invest in machinery and equipment? To make a profit. So what they have to do is they have to evaluate what is called the expected rate of return. So we have a formula to evaluate that. And expected rate of return is based on business conditions that are occurring in the economy, whether there is a demand for their product. Expected rate of return is how it is that they think that businesses are going to do, or how they think their business is going to do in the future. So again, this could be expected, be influenced by how the economy is doing. It can be influenced by tariffs. It can be influenced by taxes. It can be influenced by the geopolitical climate or opportunities that occur within certain regions. And that is going to be what drives investment. So let's see. So they're going to calculate. So businesses buy machinery and equipment and they build up their inventories because they think they're going to make a profit. They calculate the expected rate of return as follows. So let's just, I'm going to put the formula out here. Expected rate of return is going to equal the revenue that they anticipate generating from the purchase of machinery and equipment minus the cost of that equipment over the cost of the equipment. And that is going to give them some rate of return. Okay, so what we want to look at then is we want to compare, okay? We know we're going to make a profit if we buy this piece of equipment that's going to help us produce this most popular product that people want to buy, but we have to compare that to how much is it going to cost us to actually buy that piece of equipment, okay? What is the interest rate that we have to pay when we go borrow money in the financial market? So we're going to compare this to what is called the cost of capital. Okay, remember that the word capital means machinery and equipment, so this is where that comes from. The cost of capital is the same as saying the interest rate that firms have to pay to borrow money when they're going to buy machinery and equipment. Okay. So as a general rule, businesses are going to undertake all projects where the expected rate of return is greater than the interest rate that they pay. They will go ahead and undertake that project. Okay, so they're going to take projects all the way up to where the rate of return equals the interest rate they pay. So I'm going to use two sub symbols, R meaning the rate of return and I meaning the interest rate. Okay, so how many projects will be undertaken, all the way up to where R is greater than or equal to the interest rate. So that's the investment rule, if you will. So let me give you a little example here, if I can find it. Okay, let's assume that a piece of machinery costs $1,000. Okay, and this is a sanding machine that a cabinet maker would like to buy. The cabinet maker says, I think that if I get this machine, I'm going to increase my sales. So my sales are going to go up with this machine, and it's going to be $1,100. So let's calculate out the expected rate of return. So to calculate this out, we're going to go to our formula up here. We think we're going to make $1,100. We're going to take out the cost of that piece of equipment, and I forgot to put 100 here to turn it into percentages, so come back over here, put 100. Okay, and that is going to give us 10%. So we think there's going to be a 10% return if we buy this piece of equipment. Now we have to go out and borrow money for this, so we're going to be able to borrow money. If the interest rate is 8%, we'll borrow the money because we'll still get 2% return. If the interest rate is lower, like 5%, even better, we'll get a 10% return. So what are we going to do? We're going to take the expected rate of return minus the cost of capital, or the interest rate, and if this is greater than or equal to that, we're going to undertake that investment. So if the expected rate of return is 10%, and the business goes out to borrow money, and it turns out that for a small business loan, the interest rate is 7%, that means that this business is going to make a 3% return off of this investment. And so that investment, purchasing of this machine, will be undertaken. Okay, so let me give you another problem. Let's assume the following. Let's assume that there are no investment projects in the economy that yield an expected rate of return of 25% or more. So that means that there's nothing out there, a project that's going to give us a greater amount of return. But let's say that a business is looking out at all the opportunities and they find that there are $10 billion worth of investment projects that are going to give us an expected return between 20 and 25%, which is a pretty good rate of return, but it depends upon how much our cost of capital is. There's another bunch of projects that yield between 15 and 20%, and then another that yield between 10 to 15%, and so on. So what we want to do is be able to take these expected rates of return, compare it to the cost of capital, figure out which investment projects we're going to undertake, and then we're going to derive an investment demand curve. So let me write the steps up for you. 1, we're going to identify projects. Okay, we want to know what is the dollar amount, and we want to know the rate of return, expected rate of return. Okay, and then we want to compare this with the cost of capital. And then we want to see for each interest rate how much capital will be, or for each interest rate and for each comparison, how much investment will be made. Okay, so here's the problem. We're looking at all the different investment projects. Okay, so we have projects that a business can undertake, as in, let's buy a new piece of equipment, let's expand our facility. We're going to look at the expected rate of return. And then we're gonna look at the cost of capital. And then the question is, yes or no, okay? So we are given the following pieces of information. We're told that there are $0 projects that are gonna give us greater than 25%, okay? So if there's nothing out there, we're not gonna get that. There are $10 billion worth of projects that will yield between 20 and 25%. There are another $10 billion worth of projects that will yield 15 to 20%. Another group of projects that will yield 10 to 15%. And another group of projects worth $10 billion that will yield 5 to 10%. And finally, a fifth group of projects costing us $10 billion that will give us anywhere to from 0 to 5%. Okay. So what we have to do is we have to figure out, well, which projects should we do? Okay. So now what we need to do is we need to look at our cost of capital, our interest rates. Remember, this is R and this is I. Okay. So in this example, we're told that the cost of capital, or the real interest rate, is 15%. Okay, so at 15%, we have to figure out which one of these projects are we going to undertake. Okay, so we're going to look at this and we're going to see, there's no projects that are going to give us greater than 25%. So this one doesn't really count. Okay, we can't do that one. There's nothing out there. Now there's another $10 billion worth of projects that give us 20 to 25% expected rate of return, and the cost of capital is only 15%. So this is definitely a project we want to do. Why? Because if we take our 20 to 25% and subtract 15%, we are getting a return of 10 to 15%. So that is a good deal. Okay, we go down to the next level of projects. Another $10 billion worth of projects that yielding 15 to 20%. Yes, we want to do this one and this one. Those are good projects for us. Okay, 15 to 20 minus 15%, we're going to be getting at least a 5% return. There's another group of projects that cost us $10 billion, and they're going to yield 10 to 15%. Well, in this case, 10 minus 15 is going to give us a negative 5%. We don't want to do that because that's going to be a loss to us. So what we find is that when the interest rate is 15%, we are going to undertake B and C, we're going to undertake $20 billion worth of investment. Okay, so that means that we can start to build, let me put it over here, what's called our investment demand curve. So demand curve, of course, has price and quantity. The name for the price of money is called an interest rate, okay? So this is the real interest rate, or the cost of capital. And we know that at 15%, we are going to undertake $20 billion worth of investment. Okay. Then the problem goes on to say, well, what if the interest rate drops to 10%? Okay, so let's see what happens then. At 10%, what are the projects that are going to be undertaken? Well, Project B for sure, because now it became more profitable. Project C for sure, because it became more profitable. And now we can even pick up Project D. So now we know that at 10%, we're going to have 10 plus 10 plus 10, we're going to have $30 billion worth of investment. So 10%, $30 billion worth of investment. Okay. And then what if the interest rate drops even lower? Well, if the interest rate drops even lower, what happens? Let's say it drops to 5%. Well, now, of course, we can pick up Project A because it's a big return, Project C, Project D, and Project E. So when the interest rate is 5%, we're going to pick up 10, 20, 30, $40 billion worth of investment will occur, okay? So what we see is that as the interest rate goes down, the quantity of investment dollars demanded is going to increase. So we can graph this out. So let's take a moment to graph this out. I'm gonna do it right here. Q is our investment demand. How many investment dollars demanded are there? And then P is going to be our real interest rate. So remember, price goes on the vertical axis and the interest rate is a price of money. So we have 5%, 10%, and 15%. And we know that at 15%, we had $20 billion worth demanded. At 10%, we had $30 billion demanded. And at 5%, we had $40 billion worth of demanded. And this becomes our investment demand curve. Okay. So important to note, has all the properties of a demand curve that follows the law of demand. If the price goes down, the quantity demanded increases, and vice versa. Now, there are some things that will cause the demand curve to shift to the right or shift to the left that are not related to the interest rate. Okay, so remember that we have movements along the curve that are related to the price, and then we have things that cause shifts in the demand curve. And some of those items that are going to cause shifts in the demand curve are things like acquisition and maintenance cost. Why? Because that's going to lower the expected rate of return if you have to spend to maintain it, or it's an expensive item to ship to you. That's part of the cost, so that lowers your expected rate of return. Business taxes will influence the demand curve. So let me just go through these. Let me go back. Acquisition and maintenance cost. So jot this down. Shifters, 1. Acquisition and maintenance. Okay. If this goes up, okay, our expected return is going to go down. And then our investment demand curve is going to shift to the left. If acquisition and maintenance costs go down, then our expected return goes up and our investment demand curve shifts to the right. Okay. Taxes. Same thing with taxes. If taxes go up, that's a cost to us. Our expected returns go down, investment demand shifts to the left. If taxes go down, return come increase, investment demand shifts to the right. Then we have technological advance. Okay, technological advance. Well, anytime a new piece of equipment is produced that does something better than the older piece of equipment, that's going to drive investment demand. So if that goes up, investment demand will shift to the right. If technical advances decrease, then it will shift to the left. Okay. Another thing that will influence the demand curve is the stock of capital goods on hand. So firms that have excess production capacity, maybe they're not running all the shifts, they're not going to want to invest. Okay. So if the stock of goods, stock of capital, if it's dormant or not being used, investment demand will shift to the left. If all of the stock or capital is being used up, then businesses are going to need to replace old equipment and buy new equipment. So that's going to shift investment demand to the right. And finally, two more things that will cause this, planned inventory changes. Okay, planned inventory changes. Inventory is a part of investment. And so there are planned changes and unplanned. In this case, we're talking about those changes that are caused because the firms anticipate better business conditions and they're going to have to sell more. That means they're going to have to produce more, in which case they're going to have to possibly buy new equipment. And that's going to shift the investment demand curve to the right. On the other hand, if they decide we need to cut back on investment, then they're going to stop buying machinery and equipment, and that will shift the demand curve to the left. And then finally, as I had mentioned before, expectations are huge drivers on business investment. Okay. Do we think the economy is going up? Do we think it's going down? What's going on with tariffs? What's going on with legislation governing our industry? All those things will affect the demand curve. Okay. Now, investment is the most unstable of our four components of gross domestic product, of consumption, investment, government spending, and net exports, principally because it's based on the expectations of business people, and those vary for all of these reasons that we discussed. Machinery and equipment tends to last a long time. Innovation of new products varies quite a bit, and profits vary. So all those things are going to cause variability in investment.